question is, at a time when the indexing revolution is on the rise and generally too many fund managers are arguably cutting back their engagement with companies, the question is posed, can we have meaningful impact investing without some accompanying sort of shareholder activism and engagement with company management? Let me start with you, Colin. This basic question, can we have impact investing in public equities without shareholder engagement and activism? And well, yes or no?
Sure. I think I would rephrase the question a little bit, if I may. Can we have a functioning capitalism without engagement by the owners of companies with the companies themselves? One of the really exciting things about the rise of interest in impact investment is an interest in the purpose of companies, in corporate purpose. What's the company there for? If during my career a company told me it was there to make shareholders money, to generate shareholder value, that was a major alarm signal for me. That's not the purpose of the firm. It's a consequence of companies doing well, but it's not the purpose. And you turn that purpose question, which was a very powerful question for me as an engager with companies, if you turn that onto the fund managers and ask, well, what's the purpose of a fund management company? What's that for? Most people think it's to enrich the principals, the people who work there. But of course, the real purpose of a fund management company is to allocate capital efficiently, effectively in the economy. I would say nurture companies, encourage them to grow. And that's part of impact, surely, and it's part of how capitalism should work. So the real dysfunction at the heart of our system is the absence of stewardship or engagement. And I think that's something we need to address. We can talk, I guess, about the indexation and how it relates to that in due course.
But do you feel that things are changing in the right direction generally?
I think they are. I'm encouraged. For BlackRock to have someone who's looking after impact investing is really encouraging. And so the debate around this is shifting a bit. I was a historian before I became a fund manager. My first 2 degrees were in history, and that's what I thought I would do as a career. And in those days, I would have called what I'm seeing now as a hegemonic shift, a shift in language and an understanding that we apply to our jobs. And it's to do with a change in mindset, really. If you see your role as an investor as sponsoring transactions, the simple buying and selling of things, and you suppose that's how value is generated, then we have a problem. But that's where most of the industry still is. So a transactional mindset is an assumption of a world of scarcity, a kind of zero-sum game, where if we trade, your skill as a trader relative to mine determines the outcome. You're better than I am, you win, I lose. But actually, we all lose because it's a closed system. But if you realize that the trading and transacting is in real companies doing real things, the engines of wealth creation in our economy, and if you attended to the quality of those and the quality of their relationships, then you've got an expanding wealth environment that you can participate in. And that's the shift in mindset. It's away from a short-term transactional perspective to a longer-term relational one, where you see the companies that you invest in and other entities as having a set of stakeholder relationships. And if you understand the quality of those, you understand something about the value of the firm and its ability to generate value. And you can then do something about that through interaction, through engagement. And that's the position of the engager. So that's the change that's happening. And I talk to a lot of chairmen, chief executives, CIOs at fund management companies. And what I'm hearing, they don't always articulate it this way, is that they know they need to change, that they're investing in ways which damage society, the environment, the economy. And they know they can't keep doing that. But they don't know how to change at the moment. And that's a really interesting situation. And I think that's part of the interest behind.
And what do you think is the biggest constraint that's holding them back?
It's largely cultural. Wall Street makes its money fundamentally through transactions, for sure. But fund management firms don't get paid for transacting. They do it, I think, to create a semblance of activity, which means that they get paid for doing something. But I think it's really cultural, and it's to do with the relationship between the fund manager and the client. So if that's transactional in nature, then you get a short-term behavior by the fund manager, and the fund manager's short-term behavior then feeds onto the economy. And so we're consistently selling the long-term for the short-term, largely because that's just what we do. But in my career, having talked to many investment committees of large pension funds, they were really waiting to be told it's okay to do this. You know, all the advice they'd got was from people who were self-interested in transacting, and that includes investment consultants. But once you tell them it's okay, and that it's consistent with your fiduciary duty to think about the long-term performance of portfolios and how they interact with each other, it's a kind of relief. And the conversations that then I would have about the work we were doing on engagement were very lively and interactive and interested. So I think it's culture and tradition is the main obstacle, and back to purpose of the firm as well.
So Catherine, I mean, how do you see impact investing and shareholder activism for impact as being relevant to, you know, the sort of the kind of people who are supporting your organisation, the ordinary worker with a retirement income?
Well, I mean, most ordinary people in our economy who are connected into the capital markets have tracker funds in retirement schemes that mean, you know, they'll have obviously some exposure to the debt markets, but basically they're equity investors in public equities. And as we've heard a lot during the day, those ordinary people are extremely engaged, particularly younger millennials, in the impacts that companies have that they're invested in. So I'm very passionate about making sure that we find a way that those people who are not going to get access into kind of specialist impact funds and so on can be part of the impact revolution, not least when it actually directly affects their lives. So I think for investors that are interested in the clean energy revolution, for investors that are interested in affordable access to medicines, for investors that are interested in sustainable food systems or in livable wages and financial inclusion, we have to work out how to have a really intelligent, supportive, but challenging dialogue with the boards of public companies that express on behalf of millions of people who are exposed to those companies through their retirement funds the interest that those people have in sustainable ways of doing business. We have a wonderful track record now, and it's not just ShareAction, it's many others. It's a really wonderful growing community, and in fact it has to be a community because this stuff only works if you operate collaboratively. But we are signing up huge numbers of major blue chip public companies to commit to 100% renewable electric power in their global operations, off the back of a number of pension funds, foundations, asset managers saying, well, we all hold stock in these companies and we're all interested in climate change and getting this right. So why don't we have a dialogue with the boards of these companies? And we're getting fantastic results. So I think it's a very undersold story within the world of impact investing. But there are fabulous impacts to be had that are truly changing the lives of very large numbers of people by influencing the behavior of public companies and giving the boards of companies permission from the shareholders. And in the end, companies listen to lots of stakeholders, but they listen first and foremost to shareholders, giving them permission to do the right thing and to think long term and to have a more positive impact.
So you bring a campaigning mentality to it. I mean, is that a campaigning mentality that will go to company AGMs and cap a fuss, or is it more?
Well, there is a campaigning mentality, but I mean, that's not something that's not known in the capital markets. I mean, we're not the barbarians at the gates, we're the do-gooders at the gates. We are trying to engage public companies, and it is a bit of a campaigning mindset, but it's also very supportive. We're talking about investors that are holding these companies' stock, not in order to kind of in and out after changing whatever it might be that you wanted to, as an activist and investor, get that company to do. It is about a long-term mindset. But it's about challenging, and very often the interactions we have with companies reveal that, you know, half the board are really up for this, and they suddenly get this permission because they've got a bunch of shareholders in the firm, long-term shareholders, including, you know, asset owners, quite small ones, but through to sort of very giant asset managers. And I have to say that I think this is really catching on in the UK fund management industry. Some very big mainstream names are now much, much more engaged in having an impact-led conversation with the boards of companies. And it allows this debate to then happen on the boards that leads to change in action. So it's a good story.
So Sarah, FCLT focusing capital on the long term. What do you mean by that? And is it essentially the same as impact or ESG? And
So focusing capital in the long term is, as the name implies, trying to get asset owners, asset managers, and corporations to think very long term in their capital allocation process and rebalance what we see as the current overemphasis on short-termism. So I think it's different than impact in that these may be long-term capital allocation decisions in a range of industries, in a range of investments. But I think of long-termism as sort of a prerequisite for thinking about impact. Because as you said, Catherine, if you're in and out of a stock, you probably don't care very much about the impact. So the way we think about this is there's a chain of people. There are savers. Most savers are individuals who are saving for something that's very long term. Perhaps it's their retirement or the next generation, whatever it may be. At the other end of the spectrum, of the investment spectrum, there are companies that are making investment decisions. Perhaps they're going to go into a new country or develop a new product. Whatever the decision may be, they're typically quite long term. The challenge is that in between that saver who wants their capital deployed and that company who has an idea in which to deploy the capital, there is this investment chain, typically of an asset owner, such as a pension plan or a sovereign wealth fund, an asset manager, a fund manager, and then the whole IR board structure of the companies. And so the goal of FCLT is to get those three players together to develop very practical ways to make these markets longer term. Because what we find is that most people say, well, I'm long term, but I have these pressures from these other people to be short term. And so we can talk more about what some of those are. But that's the goal, and we think that that lays the foundation for impact, but it is a little bit different than
so what's the strategy? What are the steps you can see that need to be taken?
So last week we published a report which was featured in the Harvard Business Review, which you can see about, first of all, proving, if you will, that short-termism is costly. And so the punchline of that was that we took an analysis of companies that have behaved, US companies that have behaved in a long-term way versus those that have behaved in a shorter-term way. And if those shorter-term companies had behaved like the long-term companies over the last decade, we would have generated 5 million more jobs and $1 trillion of asset wealth in this country. So the impact is very large. So I think the first thing is to get over this question of, is short-termism a real issue? I think it is, and I think that we've done the research to show that. The second then is, what do we do about it? And so, Colin, you mentioned the relationship between the fund manager and the asset owner, and we think that's a fundamental part of it. So one of our first projects is on that asset owner, asset manager mandate, and it is a little bit in the weeds of capital markets, but it is, what are the incentives for those asset managers? What are the incentives for the asset owners? How does that relationship work? And then on the corporate side, we're working on the issue of quarterly guidance. We're not too worried about quarterly reporting. We think that is important to transparency and is part of the regulation in most countries. But quarterly guidance leads to all sorts of short-term oriented behavior. So those are the two things that we're focusing on at this point. So,
Colin, as you've been involved in shareholder engagement, what have you seen that works that could be applied now as we think about trying to shift fundamentally to a much more long-term orientated environment?
Yeah, so the most successful engagements are collaborative and iterative.
Collaborative between who?
Well, actually, all parties. So you recognize that so at Hermes, where I was working, when I was working there, we very rarely had more than 1% of the equity of a firm, yet we got change. And you get change through working with other investors. So we had a group of, and Hermes still has a group of 40 plus pension funds that pooled their equity together through Hermes, but we'd also need to work with others, and we did. So there's a collaboration between the owners and the representatives of owners, and there's a collaboration or working together with the company. This wasn't an adversarial activity in most cases. Lasting change, in my experience of 20 years doing this work, 20 plus years, lasting change comes about because people want to change. You persuade them of that need to change. And so it's negotiation, it's iterative, it takes time, and you work with others. And you can move very big companies a long way. A crisis is useful, for sure, but we didn't always react. In fact, most of our work was proactive, identifying companies that needed help from shareholders. And again, as I said, often they're waiting, and as was said already by Catherine, I think, often they're waiting to be told it's okay to consider these issues. They're looking for shareholder support. We would work in a pincer movement, so you'd engage with the staff doing the work on the ground, and then with the board. And that would bring it together. You gave support to the staff looking at corporate responsibility and environmental issues, the shareholder support, and then you delivered the message straight to the chairman that this is important. And that comes together within the company. So those are the sorts of techniques we would use. We very rarely put resolutions to meetings. It's very common in this market here in the US for shareholders to put resolutions to get the attention of the board. It's part of the dialogue really here. We didn't do that really anywhere else apart from the US, and we'd file 4 or 5 a year here, but it's not common in other markets. And so most of the work's done behind the scenes, working directly with the company and engaging usually at board level.
So why is this so common in the US that there's this reliance on all these board motions, whereas it really isn't the way elsewhere?
I think you should tell me, really. What I observed over those years was that it's a transactional sort of mindset again, that there's a lot of lawyers involved, and that this supported lawyers' fees to some extent. You have fewer and poorer channels of communication in the normal course between companies and investors. There's a business here in the US, in fact, that's based on that, CamberView, which helps companies engage with shareholders. That wouldn't work in the same way in Europe, I think, because the channels are much more open. So I think it's partly a transactional perspective. It's more adversarial here as well. The approach I've described to engagement, iterative, collaborative, negotiation, working with the board, getting change, it takes time. All of that is kind of dull in some ways. Important work, but it doesn't. You don't get headlines, and you're not fighting. I found in my career, if I was fighting with a company, then I was part of the problem. That you perpetuate the issue by having a fight about it. By creating that adversarial position. But if you align interests and work with people, you're more likely to get a change. So I think there's an adversarial culture here to some extent, and maybe it sits alongside that.
Catherine, how do you view that?
Well, I mean, I'm a fan at the right time and moment of holding companies accountable. And I wanted to just tell one anecdote to just try and get across the kind of work that is going on in this space. So we were approached a while ago by Médecins Sans Frontières, who've been doing some amazing work for a long time around access to vaccines. Pneumonia is the biggest killer globally of children under 5. And 2 companies, public companies, control almost entirely the market for pneumonia vaccine, Pfizer and GSK. And the cost of these drugs has gone up for children from between 2001 and last year by 68 times. So they're just unaffordable in huge parts of the global market. And there's been a whole process of trying to engage over a long period, both companies around this by the NGO community, who then reached out and said, this isn't a story that shareholders in these companies really understand very well. Can we, in an intelligent way, which really thinks about these companies' long-term business models and some of the risks of generic medicines coming up the track and so on, have an engagement with them around this? And so we put together a briefing, which we sent to the largest stockholders across the world in both Pfizer and GSK. And then there were very polite, very constructive questions at the shareholder meetings. And we got a breakthrough after what had been a very, very long time. And I think it just shows if you bring the largest shareholders in companies to the table around something, and you're asking for something which is not ruinous, in fact, for which there is a good business rationale long term, then amazing things result. So we've had a major breakthrough with both GSK and Pfizer, who've agreed that there will be access to all the humanitarian agencies of the world of pneumonia vaccine at the lowest global price. So children arriving from Syria and across the Middle East into Greek refugee camps this summer, the cost of vaccinating those children fell from $60 to $3. And so huge numbers of agencies are able to provide life-saving medicines. So I mean, it's just one really nice example of hugely impactful results. And there's many more. And I just think the problems of the world at this point are serious. We've had a good sense of that today. We have to bring the capital markets, the mainstream, the public equity investors of the world to bear on those problems in a way that actually the enlightened investors really get the long-term case for this. And so whether it's pension funds in North America and in Europe, clearly foundations, this is a huge, huge area, I think, for foundations. I would like to see a world in which foundations that call themselves impact investors all have a strategy for collaboratively working with other public equity holders to achieve positive impacts. And I think we might be on a bit of a tipping point with the foundations really piling in. And although they're very small compared to pension funds, when they work together, they bring such a lot of credibility to the table. And directors listen. So I think there's a lot of value sitting on the table, impact value, and it's not yet all being taken, and I want to see it. And I think there's real ways to get that value taken for the good of many of the causes that we've been talking about today. The whole SDG framework, we need a public equities engagement strategy for the SDGs, each and every one of them.
So Mark Campanale in an earlier panel was talking about how he hoped to see over the next year or two a real fluidity in terms of capital being taken away from those investment managers that don't vote their proxies, that don't engage towards those funds that do. Do you think that's necessary, Sarah? Do you think it's going to happen? What could make that happen?
So I guess the way that I think about the investment spectrum is that there are lots of ways to invest money, and I think mostly today we've talked about public markets. But if you think about the spectrum, there are passive investors, which we've talked about a little bit. There are quantitative investors. They may be factor-driven. They may be not necessarily engaging with companies, but being very quantitative. There are active fundamental investors, and I think we got some clapping for a few of those earlier. There are activists, or people who are really very engaged. There are private equity managers who are buying these companies. And I think it's very important for us not to just focus on public companies, because of course in this country what's happening is many companies are choosing to stay private instead of becoming public, and that causes all sorts of issues in the capital markets where we don't want the innovative companies like the Ubers of the world to opt out of the public markets, because then those companies are not available to retail investors and individuals in their defined contribution plans typically. So the way that I think of it is that there is this range of investors who each bring different tools to the table, but each one of them can use those tools to be longer term. So if they are passive investors, for example, they typically won't sell that stock. So they will typically be invested for very long periods of time. So they're very stable sources of capital for these companies, and they can vote their shares in typically large size because they tend to be big. An active manager, on the other hand, has much more the carrot and the stick of saying that they will sell the stock if they are not pleased with the way that the management is behaving. So the way that I like to think of it is that across this spectrum, there is an opportunity for any kind of investor to be thinking longer term, and by that, providing that longer term perspective, allowing and enabling those companies to make those good long-term investments that do well for them as investors and do well for them as companies and do good for job creation.
And what can we do to change the flow of money then within each of those tools?
Yep.
towards the longer term investment.
So I'll give you two examples of things that we've been working on. One is about a year ago, S&P introduced a very different kind of index. It's called a long-term value creation index. You can look it up on Bloomberg. And that is an index that is constructed. It has a number of things, but it's essentially a governance measure and a quality measure. And the way that it is weighted, it turns over much more slowly than a typical index. And this group that is backing FCLT put about $2 billion into that index. So that is one way. We've moved a lot of capital. Another is we were talking about this asset owner, asset manager mandate. And so building a much longer term relationship between the fund manager and the asset owner, which we have underway right now, and we expect we'll be able to put probably several $1 billion behind RFPs that will go into that. So the people who are members of FCLT are either large asset owners, like, for example, the government of Singapore or Washington State Investment Board. They are asset managers, BlackRock, State Street Global, Schroders, others, and they are big global companies like Unilever and AT&T. So again, like Colin was saying, this is about the collaboration among people who may be on different sides of the table on that, and that we think does move capital.
So often you hear the phrase shareholder activism, particularly in the US, associated with people like Carl Icahn and Nelson Peltz and so forth. And I wonder, is there any role for that kind of crusading shareholder activism to be actually a force for making companies behave in ways that are more pro-social, pro-sustainability? I'm thinking, I wrote a piece a couple of years ago when Bill Ackman decided to take on what was that company called that made the supplements, Herbalife, to try and drive it out of business by shorting it because he believed it was a fundamentally evil company. I mean, is there potential for more of that kind of thing, Colin?
Yeah, I think so. But these fund managers are often subject to the same short-term pressures of any fund manager, though, in terms of performance. And so the techniques are interesting and useful. But I think particularly the technique of putting someone on the board who is very well resourced. So some of these funds, they'll place a non-executive director, and that director will be supported by a team of people back at the fund management firm who really understand the company, a kind of super outside director, and that can be very powerful. So the techniques used, I think, are fine up to a point, but still fundamental dysfunction is there applied to these fund management firms, which is they need to perform for their clients over a particular period, and that leads to short-term pressures, and that flows through some of the work. So I think, returning to an earlier question, if I may, that the fund management industry does need to change and is starting to change. We're here, after all, talking about some of that. And the change will be away from that transactional mindset that I mentioned earlier to a more relational one, which recognizes an interdependence with the client. So instead of behaving transactionally with the client, they behave in an interdependent way, which will lead to different mandates.
So what's the single biggest thing that needs to happen to make that change?
Well, as I said earlier, it's culture, it's tradition.
It's not the incentives that people have.
Well, these are all symptomatic. So much work in this area address these symptoms. You think about there's a big push to promote integrated reporting. I'm sure you're all very aware of that. We think companies should report in an integrated way, a broader set of information into the reporting around the business model. And sure, we want to see that. But why isn't it happening? Is it because they don't know how to do it? Do we need some big framework of guidance to help companies report in this way? Well, that might be helpful, but it's not the point. The reason the reporting isn't happening the way we want it is because the primary shareholders aren't demanding it. The primary stakeholders, the shareholder, aren't demanding the information. And you look at a lot of the things that are going on, the dysfunctions within our economy, and they flow back to this dysfunction right at the heart of our capitalist system, which is the people charged with allocating the capital do so in a way which promotes short-term behavior, and the transacting engine, which is Wall Street in the city. That's what needs to change. And I think those fund managers that get this and recognize their role and their purpose and their interdependence with their clients and the entities they invest in, they'll prosper at a time where, frankly, we have a bit of an existential crisis for active fund management. You see all the money that's flown to passive, which, by the way, is no solution to this problem. Passive exists because it doesn't do stewardship. Surely that's why the business model works. That you can invest in 10,000 companies and hire 15 people, and call that ownership. Well, I'm afraid it's not, and hopefully more resource will flow into this. So we have a problem as an industry, which is we're not serving the economy or our clients. And those fund managers that get it and recognize their interdependence with the clients and with the entities they invest in will survive and prosper in this environment. And I think the others will not. I think they'll wither. I think we'll see a bit of a clear out of those who aren't doing the work.
Catherine, you want to jump in, and then I'll take a couple of questions.
I was just counterintuitively maybe a little word in defense of passive managers. I mean, I think active managers, at least in our market in the UK, have had it coming. They've gouged their clients for far too long. They've overcharged, and they haven't often delivered the results that they promised. Whereas the passives have something really attractive on the table, which is low fees. Now, too often that comes attached to a complete kind of derogation of duty around the stewardship function and the voting, which is an absolutely essential part of holding shares on behalf of a real client, maybe a pension saver. But it is interesting to see that the flack that Vanguard, for example, got last year for its votes, for its failure to support any of these climate change resolutions, they seem to have been, quite stung, and they've doubled down on the resources that they're applying to, people that will think about voting, in a more active way this year, and we've been having a bit of a conversation with them. I think they're quite serious. Only time will tell. The great thing is the votes are public. We can all go and have a look, see what happens. But I think there is space in the market for passive managers that vote intelligently and use that astonishing collective firepower that comes with, the vast amounts of assets that are collected in large passive vehicles. And then that's combined with, as Sarah says, other players in the ecosystem who have the resources to take a much more engaged and interactive approach with boards. But it's true that what we need to see is a sort of chain reaction whereby, pension savers of today, the millennials, through digital technology are empowered to say, we want our retirement savings invested with impact, and there's absolutely no question of that being a compromise on returns. It can't be. It needn't be. And in fact, we're increasingly showing it's really well aligned with long-term performance. And then that needs to trigger into pension funds and I've been on the board of a pension fund. The boards of pension funds are full of sleepy people that need to wake up and they need to be given a bit of a shake, so that, they're doing their duty, and then asset managers need to be rewarded, the ones that are doing a good job on this, with mandates, and we need to drive out the managers that sit around and do nothing to really engage with these issues.
But I was thinking back to Roland, and in the opening panel, he was talking about how many people they've got working at Case Depot to actually do fundamental research into long-term performance. And can you actually, passive investment is essentially a free rider on other people's work, and because it's low fees, that makes it attractive, and you can make all sorts of cases for indexing for people who aren't very smart at investing as being the best thing they can do. But nonetheless, you have a fundamental to this view that we can get capital markets to focus on sustainability and social impact is that we need more people working in researching the impact that investments have. And how do we pay for that?
Well, historically, a very large amount of the research capability has been focused on precisely the wrong questions. They were focused on what's going to drive the stock in the very short term. So we do need, of course we need, resource and capability to really research these sustainability issues. And sustainable investing, impact investing, is harder work than the laziest type of investing. But it's not impossibly resource intensive. And in fact, we need to divert some of the research capability in this industry into the right questions and away from some of the short-term questions.
Colin.
May I just come back on that? I think it is very resource intensive, actually. So Hermes, we have 30 people doing this work. Now, Hermes is not a big fund management company, and it's supported by a group of pension funds who paid us to do the work for them collectively because they were invested passively and their passive managers weren't doing it. And so they paid us a fee just for stewardship, not for fund management. And collectively, we engaged on their behalf. But this is resource intensive. And you need senior resource. You need people who understand business. It's not, you can't get someone who's just come out of university and happens to be interested in climate change or something. You know, it's nice to have people like that who are helping with the research. But if you want to change a company, you need to put someone in front of the chairman who understands the business and is credible in that environment. And that's expensive.
Do we have any questions, comments from the floor?
My name is Aziz Friedrich from Rational Vaccines, and I have a question for you, Colin. It's sort of interesting that your background is in history, and you frame this in terms of cultural differences and potentially cultural issues in the system. And so my question to you is, historically, what have been driving factors for transforming things of that nature, cultural things, and in the present environment, what do you see as drivers of necessary cultural shift in order to accommodate a different way of investing?
Thank you. It's a really interesting question. I hesitate to mention Trump again. I think there is a link to the rise in populism we've seen, the political environment. Popular anxiety around the consequences of globalization and need then to draw investment and business back towards the people. Also, there's a short-termism baked into our political process. I saw this when I was involved in the COP21 negotiations in Paris and New York, where I was sitting alongside the chief executives of Total and Statoil and they were arguing for an internationally agreed price on carbon. And the environment ministers were saying, no, there's no way we can do that, because of course any new tax is electoral suicide. So there's something in the political process which is militating us against us getting the right sort of regulation that we need for the economy. But I see this as all connected. That's kind of what I meant by a hegemonic shift. It's not just limited to investment, it's across the economy. We know we can't keep behaving this way. We need to connect the people who supply the capital, which is you, by the way, and me. It's our money that's invested in the system. And we need to connect them with the entities it's invested in, recognizing that good connection and that good stewardship leads to a better outcome for us and the economies and societies we invest in, because it's all the same thing. To continue to invest as if we're investing in single companies and driving short-term cash out of them, and then hoping somehow the economy will function and the societies will function in the way we need to do is frankly insane. we have to stop doing that, and that means connecting investors back to the companies they're investing in, and a different sort of fund management, frankly.
Sarah.
So I guess the way that maybe this is the one American on the panel. I think of it much less as a policy issue and much more about investors and companies understanding what is in their own best interest and being able to do it. It's we joke sometimes a little bit like eating your vegetables. You know it's the right thing to do, but sometimes you don't do it and you eat that cookie instead. And so I think that what investors and companies know is the right thing to do is to invest in a very long-term way, which ultimately is when companies invest in human capital, intellectual capital, and physical capital, that leads to innovation, job creation, and prosperity for societies. And there are hurdles in the way of doing that, which mostly boil down to incentives that drive the balance too much to short-termism. So I think there's a real opportunity, regardless of who's in the presidency and regardless of policies in any other countries. I think that's too much of an excuse for us as an investment community to rely on policy, whereas we think that investors, fund managers, and corporations can change their own internal policies, their own behavior in order to invest with a much longer time frame, and that will benefit society very broadly without rethinking the whole capitalist system as much as making capitalism work in the way that it really should.
Okay, so we're almost out of time, so I just want to ask each of you to throw out a challenge to this audience that's full of people with money to invest and shareholders themselves about how they can do a better job of engaging their money with companies to get them to be more impactful? Start with you, Catherine.
Well, I think if you're an asset owner of any description, then just to be having a conversation with your asset managers in the non-impact carved out part of your portfolio, which is around, tell us how you're adding value in terms of the impacts of these companies through the dialogue that you have with them, and who else in the marketplace are you joining up with for that purpose? Because this stuff has to be done collaboratively. So I think that would be a great question. And then for the asset managers, I think this is a big opportunity. I think there's growing demand, and it's not going to go away. And that's been a wonderful message throughout the whole day today, that this is happening despite the White House, despite many different trends and issues, and it's urgent that we think about the sustainability performance of our companies and of our capital markets. So asset managers that get that right, I think, will see money flow to them. So take the chance.
Sarah?
So I guess what I would add is there's been a lot of talk today about the fiduciary mindset, the fiduciary rule. Who's a fiduciary? Is that an excuse? How do you think about that? And there's been a lot of discussion about activists and activism. And I guess in both of those contexts, I would ask you all to think about, what do we mean by shareholder? Do we mean the continuing shareholder? Do we mean the long-term shareholder? Do we mean the shareholder who's still there after perhaps an activist has come and gone? And do we mean a fiduciary in terms of meeting your long-term obligations? Or do we mean the person who owns the share this nanosecond? Obviously, my view is that we mean the continuing shareholder. And if you approach most of these investment decisions with the idea that most investors in this room will be continuing shareholders, and that the right person for boards to serve is that continuing shareholder, then I think that will help us come to the right answer on many of these questions.
And Colin, last word to you.
Thank you. So the challenge, recognize your connectedness to the financial system. I guess many of you do already through your jobs or the companies that invest through you. But personally, you're connected too. Write to your trustee. You're all investing, I hope, in a pension. So write to your trustees and ask them, what are they doing about this? And get that message on to the fund manager. We are all interdependent here. We can work together, and we can make a change in the system. It doesn't require a policy response. That's not what I intended to say at all. But I do think the political changes we're seeing are an indication of dissatisfaction with the system as it is at the moment. But we can change that together. So feel your power as shareholders through your investments, and write to your trustees.
So a few years ago, when the Occupy movement was starting out, I remember writing an article saying that what we all needed to do was occupy our own money, and I think that's kind of what you're saying, Colin. And I think that seems to be one of the things that people are finally starting to wake up to. That it is our money ultimately, and how it's invested is up to us.